All right, let's get right into this explainer. Today, we're stepping into the shoes of an expert investment analyst to run a real-world community bank through the legendary valuation frameworks of some of the greatest investors in history. We are looking at TrustCo Bank Corp. NY, ticker symbol TRST. We've got the financial data, the quarterly reports, the strategic filings, the whole shebang. Now we just need to see if it survives our ultimate valuation gauntlet.
Here is how we're going to structure today's trial. First, a quick snapshot of the business. Then, we pass the stock through the qualitative and quantitative lenses of Warren Buffett, Peter Lynch, and Benjamin Graham. After that, we'll run the hard discounted cash flow and probability models, and finally, synthesize a definitive verdict.
Okay, Section 1, TrustCo Snapshot, a fortress of stability. Context is absolutely crucial before we start crunching the numbers.
This is the core question facing TrustCo today. In an era of digital-first neobanks and super complex crypto assets, TrustCo aggressively prides itself on doing the exact opposite. They completely avoid complex financial instruments. Instead, they favor traditional maturity transformation, literally just taking in local deposits and lending them out as mortgages. It is the oldest model in banking, and we need to see if it actually holds up in today's wild rate environment.
Now, our starting point for this analysis is TrustCo's recent share price of $51.67. Go ahead and pin that number in the back of your mind. This is our baseline, the market's current price tag. We'll be constantly comparing this against our upcoming intrinsic value calculations to find our margin of safety.
So what does this bank actually look like? Well, TrustCo operates a highly traditional retail depository and lending model. They're sitting on about $6.5 billion in consolidated assets spread across 133 branches. Mostly, they're anchored in upstate New York, but they've got a strategic growth footprint down in Florida. They deploy a massive 80 to 86% of their loans into safe 1 to 4 family residential mortgages. And here's the kicker: zero brokered deposits. That means no unstable, hot money chasing yield. It's just local, relationship-driven deposits that act as a total safe haven when regional banking gets turbulent.
Moving on to Section 2, the Buffett lens, quality and moat. As you know, the Oracle of Omaha cares deeply about pristine balance sheets, consistent earnings, and honest management. Looking at TrustCo's competitive position, it's uniquely defensive. Honestly, their economic moat is technically pretty narrow because they face intense regional competition from bigger banks and credit unions. But they have this incredible structural cost advantage. Their incredibly low cost of funds and massive Tier 1 capital basically form an impenetrable defensive wall. An efficiency ratio of 54% shows they are insanely disciplined with overhead. And that 19.27% Tier 1 capital ratio, that puts them literally in the 100th percentile of their banking peers. It's a true financial fortress.
So TrustCo easily survives Buffett's qualitative checklist. Return on equity is an adequate 12.39%, which is solid capital allocation. Their debt profile is highly manageable with an exceptional 10.31% equity to assets ratio. But they pass with absolute flying colors on management alignment. Corporate guidelines strictly require the CEO to hold shares equal to 4 times their base salary. Plus, insiders are actively buying on the open market. Combine that with a solid proxy for owner earnings, like generating $16.3 million in Q1 net income through expanding net interest margins, and yeah, Buffett would for sure be taking a closer look. All right, Section 3, the Lynch lens, growth and categorization. Peter Lynch famously requires us to strictly categorize a business first before we even start talking about specific growth multiples.
Based on the raw data, Lynch would confidently peg TrustCo as a stalwart or a slow grower. With a historical 5-year sales compound annual growth rate of just 2.44%, we absolutely shouldn't be expecting rapid revenue explosions here. This isn't some disruptive tech startup. Instead, as a slow grower, we're relying on dividend consistency, steady margin expansion, and aggressive share repurchases to drive our total returns.
Now, to value a slow grower, Lynch looks at the PEG ratio, taking the price-to-earnings multiple and dividing it by the growth rate. Taking TrustCo's trailing PE of 15.15 and dividing it by that 2.44% growth rate gives us 6.2. Lynch typically wants a PEG ratio right around 1.0, so at 6.2, that is quite high for his strict standards. On a pure growth-to-price basis, he'd probably pause.
But wait, a totally different narrative emerges when we check out management's behavior. Lynch absolutely loves it when management eats their own cooking. We are seeing significant open market insider purchases by the chief operating officer and directors. On top of that, they've got an aggressive 11.1% share buyback program authorized for 2026, putting them on pace to retire nearly 16% of their common stock by year-end.
Add in the low institutional ownership that naturally keeps Wall Street hot money away, and Lynch would likely view this as a fantastic, under-the-radar asset play, completely overriding that slow top-line growth.
Section 4. The Graham Lens. Deep Value Protection. Now we're going to strip away the growth narratives entirely and run Benjamin Graham's uncompromising, mathematically driven, deep value tests.
Checking off Graham's defensive list, TrustCo is a virtually flawless match. Adequate size? Easy pass with $6.5 billion in assets. Strong financial condition? That fortress balance sheet passes no problem. Earning stability? Check. But guys, the most staggering metric here is the dividend record. Over 120 years of uninterrupted dividends. Think about that. They survived 2 world wars, the Great Depression, and the 2008 financial crisis without missing a single payout. That is wild. Coupled with moderate valuation multiples of 15.15 times earnings and 1.34 times book value, Graham would definitely classify this as a prime defensive holding.
But Graham demands a hard intrinsic value calculation, right? So we explicitly apply his formula. The square root of 22.5 multiplied by the trailing EPS of $3.41 multiplied by the book value per share of $38.53. That math gives us a hard intrinsic value of $54.37. Remember our baseline market price? It was $51.67. This means the stock is currently trading just slightly below Graham's strict intrinsic value, offering a modest, though not massive, margin of safety.
Section 5. DCF and Valuation Models. Having survived the philosophies of our historical gurus, it's time to build our forward-looking quantitative scenarios. Let's establish our base case operating model based on free cash flow projections, which we've given a 60% probability. Assuming steady loan repricing as old mortgages roll off and are replaced by higher-yielding new ones, we project a 3.5% revenue CAGR. If net profit margins stabilize at their historical 33% and the outstanding share count shrinks down to 15 million thanks to those ongoing buybacks, we project a year 5 EPS of $5.04. Applying a conservative historical exit multiple of 13 times earnings, we arrive at a future implied fair value share price of $65.52.
Of course, we don't just look at the base case. Our full 5-year sensitivity analysis factors in a high case where loan demand surges in their Florida markets, pushing the target to 94.50. We also have to model a low case where intense credit union competition squeezes margins, dropping the valuation to 35.50. When we multiply these future prices by their respective probabilities, 20% high, 60% base, 20% low, we get a total probability-weighted fair value target of $65.31. This gives us a really robust valuation range.
Section 6. Synthesis and Final Verdict. Let's pull all these distinct valuation frameworks together and finalize our thesis.
Bringing it all together, at the current market price of $51.67, the stock sits about 5% below Graham's strict intrinsic value of $54.37. But it offers a much healthier 20.9% discount against our 5-year probability-weighted model of $65.31. So strictly by the quantitative metrics, the stock is undervalued right now, and that's heavily supported by those aggressive share buybacks and an unshakable top-tier balance sheet.
However, as an expert analyst, you absolutely have to weigh the risks. And we have to talk about TrustCo's severe duration mismatch, because 80 to 86% of their assets are 30-year residential mortgages. Those assets reprice very slowly. Meanwhile, retail deposits, which are their primary liabilities, can reprice rapidly in a high interest rate environment. So their old mortgages are locked in at low rates, while they're simultaneously forced to pay out higher yields on deposits today just to fight off local credit unions. That rate squeezes the elephant in the room and the single biggest operational threat to their profitability right now. So, blending all these insights from Buffett, Lynch, Graham, and our own quantitative models, our final verdict is that TrustCo is a fortress of stability. It's an ideal target for cautious dividend seekers and fits perfectly into a defensive accumulation strategy. Now, strict value investors looking for maximum protection might patiently wait for a slight dip below $50 to guarantee a wider margin of safety, and pure growth investors, well, they'll likely look elsewhere. I'll leave you to ponder this final thought. We spend so much time chasing the next big tech multiple or disruptive innovation, but there is immense, undeniable power in simple, disciplined execution. As you consider how traditional banking resilience fits into a modern, fast-paced portfolio, ask yourself, is a 120-year unbroken dividend streak the ultimate safety net? Thanks for joining me on this explainer, and as always, keep learning.